Hello and welcome to the Morningstar series Ask the Expert. I'm Emma Wall and I'm joined today by Simon Dorricott, Senior Fund Analyst for Morningstar. Hi Simon.
Hi.
So we're looking at emerging markets today. Let's just start with 2015. Not a great year for emerging markets thanks to Chinese volatility, oil prices falling. What happened?
Exactly. So emerging markets investors had a pretty torrid 2015. Returns were quite weak, so pretty significant negative returns for investors there. Obviously, commodity prices were a significant influence there. Certain countries were especially weak, so Brazil and South Africa, where both the equity markets and the currencies were hit quite hard. Again, due to commodities, but also some concerns over domestic economic growth and some political issues as well. In terms of sector performance, obviously those commodity-related areas underperformed. Better performance was seen from some more growth areas, so IT, and also healthcare did reasonably well.
2016, however, has been a completely different story. It's almost turned everything on its head, hasn't it?
Yeah, that's exactly right. So much better for emerging markets as a whole. So investors there have outperformed developed markets and shown a positive return. I think we've seen a general increase in risk appetite. We've also seen the Fed in the US signal that interest rates are only going to rise on a very slow basis. So that's allowed certain currencies in EM to strengthen. We've also seen some, as I say, commodity prices have improved significantly. So iron ore, oil prices moved up
gold
quite a lot, indeed. And we also had quite a few valuation discrepancies there. So the differences between certain stocks in terms of valuation had widened quite markedly, and that's all contributed to a change around and much improved returns. And in fact, if you look at the countries that have done well, we've actually seen Brazil and South Africa, a couple of the laggards from last year, doing much better on the back of both equity market performance and strengthening currencies. In the case of Brazil, I think there's a little bit more optimism in terms of the political situation and potential for economic reforms that any change there could bring.
This movement then from the sort of growth stocks doing well to the value stocks doing well is not unique to emerging markets. We're seeing it actually across the globe, but commodity prices in particular having an impact in the emerging regions. Presumably there are fund managers who will do well in one set of circumstances and fund managers who will do well in another. How have 2015 versus 2016 fund performances reflected that?
Well, we have seen some quite marked differences between different managers with slightly different styles. So in emerging markets, you don't necessarily think of growth and value managers, or the distinction isn't quite as marked as it would be in certain other markets like the US, for example. But if you look at the returns from some of the managers that we have rated, it's perfectly clear that the growth managers like Vontobel and Fidelity, who were top quartile performers in 2015, have really dropped down the performance charts year to date and are in or very close to the bottom quartile this year because of that growth bias and exposure to consumer sectors and India. Whereas the more value-orientated managers such as M&G or Lazard as well, they've really risen to the top of the pile. So top quartile performances from those managers tend to be overweight Brazil, underweight the more expensive areas such as consumer staples. And it's good to see them having their day in the sun.
Simon, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.